My article over the weekend took the quote from The Economist, which said Africa looks more like Italy than China. Markets have certainly been moving around a lot of late. Everyone has been transfixed by the price of oil, with the benchmark Brent crude contract topping a 3.5-year high and $77 a barrel last week. President Trump, whose political raison d'etre is to expunge and delete the name of Barrack Hussein Obama from the record, delivered a unilateral hard exit from the nuclear agreement with Iran, thus lifting oil prices. In fact, President Trump has flipped Obama's oil warfare strategy. You will recall oil prices touched $32 a barrel in President Obama's term, in part to bring a recalcitrant Russia to heel and neuter Saudi resistance to his JCPOA deal on its head. Trump, I suspect, is seeking to assist the Crown Prince of Saudi Arabia up the greasy kingdom of South Pole, and the Kremlin is, I am sure, not complaining. Over the weekend we saw lots of comment about Rosneft as well. The US dollar has been strengthening across the board. Emerging markets bonds, which in late January this year touched a record low spread versus the equivalent US Treasury, just above 200 basis points versus 5-year US Treasuries, blew out. The spread now is at 275 basis points. Argentina, which incredibly sold a century bond just last year after dialing up interest rates to an eye-popping 40%, has capitulated and dialed up the IMF's Madame Lagarde. At this point in the cycle, the IMF's importance for many countries cannot be gainsaid. Turkey's lira crashed to all-time lows. Countries that had been flying by the seat of their pants are now being caught with their pants down. This has all the ingredients for baking a good old-fashioned crisis. The signal in the noise is the yield on 10-year US Treasuries, which yield is around 3%. If we move to 3.5%, we could see a further round of bloodletting. Sub-Saharan African governments have tapped the Eurobond markets for more than $15 billion so far this year, which is a record haul for any year ever, and it's not even June. The IMF, in its latest Africa update, judged 6 countries to be in debt distress: Chad, Eritrea, Mozambique. Mozambique have lashings and lashings of natural gas, which means there is a pathway out of this. Congo Republic, South Sudan, and Zimbabwe. In Zimbabwe's case, there is sufficient goodwill for Zimbabwe to exit their current impasse. Interestingly, the IMF's ratings for Zambia and Ethiopia were changed from moderate to high risk of debt distress. In Zambia's case, Eurobond yields are nudging double digits, and President Lungu is resisting the only option that is really available, which is the IMF. During the IMF's release, its Africa head said, "The question I ask is, why isn't a country growing at 6 or 7%? Faster growth is a panacea. In fact, after growing just 1.4% in 2016, a more than 20-year low GDP print, the IMF is projecting growth across sub-Saharan Africa of 3.4% this year. SSA aggregate figures are driven by the big 3 economies of South Africa, about which I'm constructive because of the swing from a scenario of a vicious Zuma discount to a Ramaphosa premium, Nigeria and Angola. All 3 countries are bouncing off the bottom. The proof of the pudding will be in the eating, however, and the sustainability of the rebound. The IMF expects that income per person will shrink in all 3 in 2018 for the 4th consecutive year. That means the average individual is empirically worse off for the 4th consecutive year. The Economist correctly concludes there is reason to worry then when the IMF says that regional growth will hover below 4% for the next few years. Since populations are rising, income per person will creep up by barely 1% a year. That makes Africa look more like Italy than China. Better keep praying. The Daily Maverick cited Nigeria as an example. For example, Nigeria, Africa's largest economy, is home to almost 200 million people. Its population is growing at 2.61% per year, with a median age of 18. But Nigeria's economy is set to grow by just 2% in 2018. The implications of this are nothing short of disastrous. Bloomberg's annual Misery Index places 6 African countries in its top 10 most miserable countries globally in 2018. Last week, when delegates were asked at the Moody's Investors Conference in Lagos what they thought were the biggest risks for African borrowers, they were not worried about external shocks so much as homegrown ones. Africa has fully loaded the balance sheet, notwithstanding a record-breaking Eurobond raise in 2018. It's as plain as day that the current scenario is a little like Argentina's century bond moment, a last hurrah. African governments need to improve their ROI because envelope space could evaporate momentarily and in a blink of an eye. Investors are demanding the most extra yield to own dollar-denominated emerging market sovereign debt versus benchmarks since early 2017, which reiterates the point I was making. And here we see returns to date in financial markets from Chico.